Okay, so what I'm going to simply do today is give you a brief introduction to the basis for this entire class. So I'm going to give you today the accounting equation, and we're going to talk a little bit about it, and then we're going to go into much more detail on Thursday after you've read the chapter. Okay, first of all, what does this stand for? Assets equal liabilities plus owner's equity. Ever heard that before? If you have some experience. If you have not, this is what we're going to learn. Notice that there's this side of the equation, or the left side, and there's this side of the equation, or the right side. That will come into play later when we learn about T accounts and debits and credits, but we're not going to talk about those today. First thing we're just going to talk about is this equation must always remain in balance. Always remains in balance. If you're increasing this side has to increase. If you're decreasing this side has to increase. Assets always equal liabilities plus owner's equity. Okay. Let's talk for a brief moment about each one of these, and then we'll repeat those again on Thursday. First of all, what are assets? What do you think assets are? When someone says you have a lot of assets?
Assets are things that are valued.
Good. Things of value. What would be things of value for a business? Yeah. Products. What else? Property. Okay, so you're getting the gist of what assets are, things of value. Now, liabilities. Debt. Good. Things you owe or debt. She's saying like payroll. Actually true, because an example is something called salaries payable. Maybe you've earned your salary, but you haven't been paid yet. But for the business, it's a debt now because they're going to have to pay you. Another one is simply this one. Accounts payable. And I'll always abbreviate it A/P. Too much to write out, accounts payable. So A/P, accounts payable. What would this be? Bills, things you've charged. Maybe you bought some equipment but didn't pay for it. That is a debt or a liability to your business until you pay for it. Okay? Now, owner's equity. We're not going there yet, but we will yet. Owner's equity. What is owner's equity? Okay, good. Capital, or the equity in your business, combining it with liabilities that equals your total assets. Capital is called a permanent owner's equity account. Permanent. Because will you want to ever close out your capital account? No. If you close out your capital account, what happens? Your business goes goodbye. which does happen a lot. So capital is a permanent owner's equity account. Now, there are categories that fall under it that are temporary in nature. Let's talk about them. What would make the value of your or equity in your business go up? What could you do with your company to increase the value of that company? Sell products or bring in revenue. You could sell products, or as we're going to do for the first few chapters, we're going to provide services. That still brings in money. So revenue, that's going to increase your capital or increase the owner's equity in the business. Now, what's on the flip side of revenue? Okay, profit's still going to be increased. Okay? Can an owner take money out of their business? Yeah, they shouldn't, but they do. Yes, they can, actually. Yeah. It's called withdrawals. And if the owner takes money out of their business for personal use, it's going to decrease that capital account or decrease the owner's equity. Does that make sense? If they're taking money out, they don't have as much value in that business. What else would make that value or that equity in the business go down? It's associated with this one. If revenue makes capital go up, what would make it go down? Yeah. Expenses. Unfortunately, to make money, we have to spend money. So we have a lot of expenses associated with this revenue. Give me an example of some expenses that a business would have. Yeah. Advertising. Okay. So salaries expense. We can list a lot of other ones. Rent expense, maybe utilities expense, depreciation expense, something we're going to find out later. That's an expense of the business. Those are all expenses that are required for the operation of this business. Now, unfortunately, when we determine our profit, we can't just determine the money that we bring in from selling our products or services. We must also subtract those expenses associated with bringing in that profit. And hopefully that comes out as a positive. Otherwise, that permanent capital account is going to go down in value. But if we make a profit, it's going to continue to go up. So all of these are temporary owner's equity accounts. Temporary owner's equity accounts. That means that we will close them out at the end of any given period in order to update this permanent capital account. So again, without looking, what is our accounting equation? Assets equal liabilities plus owner's equity. If you know any two of those totals, you can figure the other one out, correct? Yes, those of you that have algebra knowledge.